Welcome to the FinGlimpse podcast, where we analyze the world of business, finance, and the economy. We cover the latest market news, economic trends, and some interesting businesses. As a standard disclaimer, this podcast is for informational purposes only and should not be considered investment advice. Always do your own research. Now, let's get started.
Ever feel like you need the clearest picture of what's really happening in India's economy and financial system straight from the source? Like getting the most important insights without having to wade through, hundreds of pages. That's exactly the mission for this deep dive.
Yeah, official reports can be pretty dense, but they really hold the authoritative view on, well, the economic landscape, policy actions, and where things might be headed. Our goal is basically to make that vital information accessible and hopefully understandable for you.
Absolutely. Today, we're cutting straight to the core of a major document. Excerpts from the Reserve Bank of India's annual report for 2024-25. This is the central bank's own assessment of the past year and a look ahead, too.
Which we'll try to extract the most significant nuggets of knowledge, highlight maybe some surprising facts, and connect the key insights, just to help you feel truly well-informed about where India stands economically and financially and what the RBI has been, focusing on.
We'll break down the complex stuff, find those aha moments, hopefully, and connect the dots for you, making sure we don't get lost in unnecessary jargon. Okay, let's unpack this. So, the report kicks off by giving us the overall economic snapshot. It reviews 2024-25 and lays out prospects for 2025-26. Looking back at the year that just wrapped up, how did the economy perform according to the RBI? What's the headline number?
Well, the report's assessment highlights solid real GDP growth. The second advance estimate for the full year 2024-25 came in at 6.5%.
Okay, 6.5% growth for the year. That's a strong figure, but I think the report also notes something about investment trends, which are so crucial for future growth.
Yes, exactly. It points out a moderation in the growth rate of gross fixed capital formation. That's essentially, investment in things like buildings, machinery, infrastructure. It grew by 6.1% in 2024-25, which is down from 8.8% the previous year.
And were there specific indicators the RBI looked at that sort of mirrored that softening?
Yeah, the report uses what it calls coincident indicators, things that tend to move along with investment, like steel consumption, cement production, and the production and imports of capital goods. These also showed a similar, softening trend. Meanwhile, the manufacturing capacity utilization rate was noted at 75.3%.
75.3%. So that suggests there's still some room to grow before industries feel pressure to invest heavily in new capacity.
That's the implication, yes. Still some slack there.
Okay. Shifting focus to a really fundamental sector for India, agriculture. The report details the minimum support prices, the MSPs.
Right. For the 2024-25 Kharif and Rabi crops, the MSPs were set with a specific target, ensuring farmers receive a return of at least 50% over their cost of production. And the report highlights that for wheat, the return was actually significantly higher, at 105% over cost. Paddy met the 50% target.
That's interesting detail on a key policy area. Anything else significant on the rural side?
Well, there's a focus on promoting sustainable farming practices. There's quite an ambitious plan to bring 1 crore farmers under the National Mission on Natural Farming. And the report also uses domestic tractor sales as a kind of indicator of rural demand. It noted a recovery in Q3 and Q4 of 2024-25, which suggests maybe some improvement in farmer sentiment, maybe income.
Looking ahead now to the current year, 2025-26, the report seems a bit more optimistic about certain sectors driving growth.
It does. It points to a positive outlook for both the manufacturing and construction sectors. And this optimism is apparently supported by factors like, expected improvement in domestic demand, higher utilization of existing capacity,
Okay.
healthy balance sheets for businesses and banks, which allows for more lending and investment, and a general uptick in consumer and business confidence surveys.
And policy support is also playing a significant role there, I assume.
Absolutely. Government policies like the Production-Linked Incentive Scheme, the PLI scheme, and the National Manufacturing Mission are expected to boost manufacturing. And for construction, increased allocation for housing schemes like PMAY is key. Plus, the planned second asset monetization plan.
Ah, yes, the asset monetization.
Aiming to unlock 10 lakh crore through monetizing public assets. That's expected to give a massive boost to infrastructure development.
So the expectation is these factors will create a sort of virtuous cycle in the economy.
Precisely. By boosting activity in manufacturing and construction, the report anticipates these will lead to job creation, improve household incomes, and ultimately feed back into strengthening that crucial domestic demand.
What about the services sector? That's such a large part of the economy.
Right. The services sector, after some fluctuations, saw a rebound in the third quarter of 2024-25. That was driven primarily by trade and construction-related services. And the services sector composite index, which gives a broader picture, remained robust in the fourth quarter, indicating continued momentum.
The report also pulls in insights from the periodic labor force survey on employment for 2023-24. What were the big takeaways there?
Some significant trends were noted. The survey showed the highest labor force participation rate, LFPR, and worker population ratio, WPR, since the survey actually began. And a key driver for this improvement was a noticeable rise in the female labor force participation rate. That's a really important development for the economy.
Oh, absolutely. That's huge.
Yeah. The overall unemployment rate remained unchanged, but there was a decline in urban areas, which was offset by a marginal increase in rural areas.
That increase in female LFPR is potentially transformative. The report also touches on innovation and potential risks to this growth outlook.
On innovation, it mentions India's share in global R&D expenditure is about 2.6%, with R&D at 0.64% of GDP back in 2020-21. The report notes that while R&D positively impacts total factor productivity, basically, how efficiently we use labor and capital, this link is often, more pronounced for advanced economies.
Right, makes sense.
And the clouds on the horizon. What are the main risks the RBI sees to this positive growth picture? The report highlights potential risks coming from increased input costs for businesses, ongoing geopolitical tensions globally, and the possibility of, subdued global demand impacting India's exports. These are definitely factors requiring careful monitoring.
So that's a pretty comprehensive overview of the economy's health and prospects. Now, managing that economic activity goes hand in hand with keeping prices stable. Let's zoom in on the price situation.
Okay, so the report indicates that headline CPI inflation, the main measure you hear about, moderated. It averaged 4.6% during 2024-25. That's down from 5.4% the previous year.
Good progress, but like the economy, it wasn't a perfectly smooth ride throughout the year, was it?
No, not at all. The report details quite a bit of fluctuation within the year, and this was mainly driven by volatile food prices. Weather disturbances caused some supply-side shocks, leading to food inflation hardening at times, which then corrected later in the year with better crop arrivals, especially winter crops.
Okay. What were the overall factors that helped bring inflation down over the course of the year?
The report lists several key drivers. Robust agricultural production helped on the food supply side. Global commodity prices, particularly for food and energy, softened somewhat. Supply chain pressures eased significantly.
That's a big one.
Government supply management measures played a role too. And importantly, the lagged impact of the monetary policy actions taken by the RBI earlier. Rate hikes take time to work through.
How did fuel prices behave?
Fuel prices actually remained in deflation, meaning they fell on average during 2024-25. That was primarily due to lower LPG and kerosene prices.
And core inflation, the one that strips out the volatile food and fuel bits, how did that trend?
Core inflation also eased throughout the year. It reached its lowest point in the current data series early in 2024-25. And after that, there was what the report describes as just a benign uptick in the following months. So this suggests underlying price pressures were relatively contained.
Okay, so putting it all together, what's the RBI's outlook for inflation going forward, and what are they keeping a close eye on?
The report anticipates a gradual moderation in headline inflation. Partly, they're expecting softening food inflation from a better rabi crop yield. However, it's cautious. It emphasizes the significant uncertainties posed by geopolitical conflicts, evolving global trade dynamics, and, of course, weather conditions.
Always the weather.
Always. These factors require continuous monitoring and vigilance, as the report says, to keep inflation on the desired path.
Vigilance is definitely the word. Okay, moving from managing overall prices, let's look at the financial plumbing of the economy. The RBI plays a huge role in developing and regulating India's financial markets.
It certainly does. The report details the Reserve Bank's continuous focus in 2024-25 on developing and deepening financial markets, streamlining regulations, and encouraging innovation in this space.
And there was a really interesting point about innovation in cross-border payments I saw.
Yes. That's quite notable. It's the Reserve Bank joining Project Nexus. This is a multilateral initiative aimed at enabling instant cross-border retail payments. It's linking India's fast payment system, UPI, with those of 4 ASEAN countries: Malaysia, Philippines, Singapore, and Thailand.
Wow.
Yeah, think about the potential for simpler, faster money transfers for individuals and small businesses across these countries. It could be quite significant.
Instant payments across borders, that sounds like a major practical step forward. How's India doing on financial inclusion overall?
Good progress here, according to the report. The Financial Inclusion Index, the FI Index, which tracks access, usage, and quality of financial services, improved. It went from 60.1 in March 2023 to 64.2 in March 2024.
And what drove that improvement?
The report notes that usage of financial services was the main driver behind this improvement. So people aren't just getting access, they're actually using the services more.
That's key. Did they highlight any specific initiatives linked to financial literacy or inclusion?
Yes. They noted the theme of Financial Literacy Week in 2025 was Financial Literacy Women's Prosperity. This highlights a specific focus on empowering women through financial knowledge, recognizing their crucial role, in household finances and the broader economy.
Good focus. Now, how has monetary policy transmission been working? That's the process of RBI's rate changes affecting borrowing and lending rates out there in the economy.
Right. So the transmission of policy rate changes to banks' lending and deposit rates continued in 2024-25. The report does note that the pace was somewhat slower compared to earlier periods, but interestingly, overall transmission has actually strengthened in recent years.
Strengthened. Any specific numbers on that?
The report shows weighted average lending rates, WALs, on fresh rupee loans declined by a small 2 basis points. On outstanding loans, they fell by 8 basis points. On the deposit side, the weighted average domestic term deposit rates, WAR DDRs, on fresh deposits saw a small increase of 3 basis points. And on outstanding deposits, a slightly larger increase of 14 basis points.
Okay. And why has transmission strengthened overall?
The report credits the overall strengthening transmission to the RBI's efforts to improve transparency in how banks calculate and display their lending rates, like the external benchmark-linked rates.
Got it. What about overall bank credit growth? Was that strong?
Yes, bank credit growth remained robust. It stayed in double digits throughout 2024-25. This growth was primarily led by lending to the retail and services sectors. Bank credit to the commercial sector grew by a solid 11.8%.
And lending to the government?
Net bank credit to the government also increased by 11.2%. The report also mentions banks continued to hold excess statutory liquidity ratio securities, SLR securities, suggesting they maintained, healthy liquidity buffers.
Okay. And the corporate bond market, what was the landscape like there?
Corporate bond yields generally softened during 2024-25, mirroring the trend we saw in government securities, GSECs. This basically means it became slightly cheaper for companies to borrow by issuing bonds. The report gives examples of yield declines ranging from 15 to 33 basis points for AAA-rated 3-year bonds, depending on the issuer type.
Did market activity pick up?
Yes. Secondary market turnover increased, and primary issuances were also up. Though private placements continued to be the preferred channel by a huge margin, like 99.2%. And foreign portfolio investor FPI interest in corporate bonds also increased.
Speaking of FPIs, how much did they invest in Indian debt instruments overall over the year?
The total FPI investment in debt instruments in 2024-25 was pretty substantial, 1.5 lakh crore. The report mentions the 3 main channels FPIs use to invest in Indian debt, including the Fully Accessible Route, or FAR, which has been designed to make certain government securities fully available without restriction.
Okay, that gives us a clear picture of the domestic financial markets. Now let's look outwards how India interacts financially with the rest of the world, the external sector.
Right. The report provides some key insights into merchandise imports. For instance, POL, that's petroleum, oil, and lubricants imports, saw growth, driven mainly by higher volume, reaching about $185.8 billion.
I saw a really intriguing detail about electronic goods trade. It's usually a deficit area for India, but there was a surprising bright spot mentioned.
You're right. India continues to have a trade deficit in electronic goods overall, primarily due to imports of components and computer hardware. However, the report notes a significant and somewhat surprising trade surplus of US $3.7 billion, specifically in telecom instruments.
A surplus in telecom instruments, that is surprising.
It is. It highlights some real strength in that particular manufacturing segment.
That's promising for that sector. What about major commodity imports like coal?
Coal imports saw a significant fall, 20.0% year-on-year in 2024-25. This was a result of both lower import volume and prices. helped quite a bit by increased domestic coal production. This decline contributes positively to India's import bill, obviously.
Okay. How did external commercial borrowings, the loans Indian companies and entities take from abroad, how did they fare?
Net ECB inflows to India saw a very substantial increase in 2024-25. They rose to US $18.7 billion.
Wow, 18.7 billion. That's a huge jump compared to the previous year, wasn't it?
A very big jump. It was only US $3.6 billion the year before.
What's behind that massive surge, do we know? And where did that money go?
Well, the increase likely reflects a combination of global financial conditions and the relative attractiveness of the Indian market for borrowers. As for usage, the report details that the major shares went towards on-lending or sub-lending within India, that was about 45.3%, and for infrastructure development, which was around 6.3%. The report also noted borrowers showed a preference for naturally hedged loans.
Naturally hedged. What does that mean?
It means loans taken in a currency where the borrower also has earnings, so it reduces the risk from exchange rate fluctuations, for example, an exporter borrowing in dollars.
Got it. What about shorter-term trade credit?
There was also an increase there. Short-term trade credit showed a net inflow of US $11.1 billion during April-December 2024. This is a notable turnaround from a net outflow in the same period a year prior. It suggests, smoother financing for India's trade activities. And the report mentions that around 32% of this credit was raised for imports of major commodities like crude oil, gold, coal, and copper.
The RBI also represents India on the international stage. What did the report say about those engagements?
The Reserve Bank actively participates in major international forums, including the IMF's biannual fund bank meetings and its Article 4 consultations. That's where the IMF assesses a country's economic health.
And how did the IMF view India recently? Was it positive?
Yes, the IMF's Article 4 report on India, which came out in February 2025, gave a positive assessment. It highlighted India's robust economic growth, the resilience of its financial system, inflation broadly declining towards the target band, and ongoing fiscal consolidation efforts by the government. India also continued its support for the Brazilian G20 presidency and is preparing as South Africa takes over the role.
That provides a clear view of India's economic performance and its global interactions. Now, none of this activity happens in a vacuum, does it? Let's look at how the RBI acts as the crucial steering wheel through its regulation and supervision to maintain financial stability.
Exactly. And the report opens this section by stating quite clearly that the domestic financial system remains sound and resilient during the year. It emphasizes the RBI's continuous efforts not just to fortify the system against shocks, but also to promote responsible innovation, while at the same time addressing challenges like technological disruptions, cyber risks, and the growing impact of climate change on finance.
The Department of Regulation seems to be the core of this work, right?
It is. It's the central point for regulating a wide range of financial entities, everything from commercial banks and urban cooperative banks to NBFCs, non-banking financial companies, and others.
There's a significant discussion in the report about updating the framework for dealing with willful defaulters. Can you maybe explain what that is and why it was updated?
Sure. A willful defaulter is essentially a borrower who has the capacity to repay a loan, but deliberately chooses not to, or maybe siphons off funds elsewhere. The RBI reviewed its existing instructions on this, taking into account recent court judgments and feedback, and issued a refined master direction in July 2024. The aim is really to strengthen the framework and make the process fairer and more effective.
What were some of the key changes in this updated framework? What makes it refined?
The refinements focused a lot on procedure and transparency. They include ensuring all material information is disclosed to the borrower. They also provide a formal opportunity for the borrower to submit a written representation against a potential classification as a willful defaulter, and ensuring a personal hearing is given by the review committee.
Okay, procedural fairness.
Exactly. And a very important addition is the emphasis on early detection. It requires banks and NBFCs to review all non-performing asset (NPA) accounts within 6 months of their classification as NPA for potential signs of willful default. And this framework applies broadly across different types of banks and many NBFCs.
That focus on early detection seems particularly crucial. The report also mentions rationalizing prudential norms for urban cooperative banks, or UCBs.
Yes, recognizing the unique structure of UCBs, the RBI reviewed and rationalized some of their prudential norms in February 2025. The goal seems to be to give them greater operational flexibility while still maintaining strong regulatory standards suitable for them.
Can you give a couple of examples of those rationalized norms?
Sure. Key changes included increasing the limits for small value loans, which helps these banks serve their local communities better. They also rationalized the overall exposure limits for housing and real estate loans based on the bank's total loan book, and increased the monetary ceilings for individual housing loans for smaller UCBs Tier 3 and Tier 4, allowing them to support larger housing projects in their areas.
Any other examples?
Yes, another change was extending the timeline, or the glide path, by an additional 2 years until 2027-28. This is for how UCDs need to provision for security receipts, SRs they hold, related to transferred stressed assets. Gives them a bit more time to adjust.
Okay. They also made some adjustments to risk weights. Remind us what risk weight means in this context.
Right. Risk weights determine how much capital banks need to set aside against different types of loans or assets based on how risky they're perceived to be. A higher risk weight means the bank needs to hold more capital, which can make that type of lending more expensive or constrained.
And what changed?
The report mentions reviewing weights for microfinance loans, and notably, restoring the risk weight on commercial banks' exposures to NBFCs back to being based on the NBFC's external credit rating. That happened in February 2025.
Interesting. With AI becoming so prevalent everywhere, how is the RBI approaching its use in the financial sector?
This is a very important area the report addresses. Recognizing the growing adoption of AI and machine learning by financial institutions, the RBI constituted an external committee in December 2024. This committee is specifically tasked with recommending a framework for responsible and ethical enablement of AI. They're calling it free AI for the financial sector.
Free EAI. Oh,
Yeah. It shows the RBI is proactively thinking about how to harness AI's potential while managing risks like bias, security, and explainability. The RBI is also exploring using AML internally for its own work.
makes sense. What about supervision? How is the RBI prioritizing where it focuses its attention?
The RBI uses a risk-based supervisory framework. For entities like full-fledged money changers and some non-bank authorized dealer Category 2 entities, a revised framework was introduced in June 2024. Basically, this means the frequency of inspections is now linked to their risk rating. Higher risk entities get more attention, with a particular focus on compliance issues like KYC, Know Your Customer, and AML anti-money laundering rules.
And strengthening defenses against financial fraud, that's always critical.
Absolutely.
Correct.
The report discusses revised directions on fraud risk management for regulated entities, issued in July 2024. These are principle-based, so less prescriptive, more outcome-focused. They clearly strengthen the oversight role of the entity's boards. And they enhance the framework for early warning signals, EWS, and red flagged accounts, RFA, which might indicate potential fraud.
And fairness in classifying fraud.
Crucially, yes. Aligning with the Supreme Court judgment, they explicitly require adherence to principles of natural justice, ensuring fairness before classifying entities as fraudulent. And these directions apply widely, including to regional rural banks and housing finance companies.
Okay. Finally, on this section, the report gives a glimpse into the RBI's own internal operations and risk management.
It does. It mentions the structure involving the central board and various specialized subcommittees, like the Strategy Subcommittee and the Audit and Risk Management Subcommittee, ARM and EMS. They've also been strengthening internal processes like their mentoring policy, which is called SABLE.
And their enterprise risk management framework, how does that stack up?
Well, they benchmarked their existing enterprise risk management ERM framework against global best practices and found it largely conformant. Recommendations from this exercise have been incorporated into their updated ERM 2.0 framework, which helps manage risks across the entire organization. Internal audit serves as a key third line of defense in this structure, providing independent assurance.
That's a comprehensive look at how the RBI maintains the stability and integrity of the financial system. Right, let's switch gears now to the actual pulse of money, how we make payments, the technology behind it, and the management of physical currency.
Yeah, this section really touches on what you and I interact with daily. The Digital Payments Index, which tracks the growth of digital payments across the country, continued its upward trend. It reached 465.3 in March 2025. That number itself tells you there's continued significant adoption of digital payment methods. The growth is quite something.
That growth is indeed massive. What were some of the specific initiatives in the payment space highlighted in the report this year?
There were several important ones. To make small-value digital payments easier, the UPI Lite wallet limits were increased back in October 2024. The per-transaction limit went up to 1,000, and the overall wallet limit you can hold went up to 5,000.
Okay, making UPI Lite more usable.
Exactly. And to broaden access to UPI, Permission was given in December 2024 for linking prepaid payment instruments, think digital wallets, through third-party UPI applications. Plus, small finance banks were permitted to extend pre-sanctioned credit lines via UPI in February 2025. This could make it easier for customers of these banks to access small loans directly through UPI.
Were there measures focused on security and preventing fraud as well?
Yes, definitely. To help prevent errors and potential fraud in large value transfers like RTGS and NFT, a beneficiary bank account name lookup facility was introduced in December 2024. It allows you to verify the recipient's name matches the account number before you send.
That's useful.
Very useful. And in February 2025, the RBI proposed enabling an additional factor of authentication like an OTP for international online card transactions, adding an extra layer of security for those.
There was also a change related to ATM fees, wasn't there?
Correct. A revised ATM interchange fee structure was issued in March 2025. This allows banks, from May 1st, 2025, to potentially charge customers up to €23 per transaction beyond the mandatory free transactions they're entitled to at ATMs. The report also notes the ongoing availability of interoperable cardless cash withdrawal at ATMs, enabled since 2022, which offers convenience and potentially more security.
And something about accessing government securities via stockbrokers.
Yes, a Stockbroker Connects facility was introduced on the NDS-OM platform, that's the GSEC trading platform, in February 2025. This allows SEBI-registered stockbrokers to access the platform on behalf of their individual clients. It makes it potentially easier for regular investors to trade in government securities.
Interesting. Beyond the payment systems themselves, the report talks about IT and digital transformation within the RBI. What's happening there?
A significant initiative launched in May 2024 was PravaH. This is a secure, centralized, web-based portal. It's designed to digitize the process for regulated entities, banks, NBFCs, etc., submitting applications and requests to the RBI. Its purpose is to enhance the ease of doing business and improve transparency in regulatory interactions.
And it's been successful.
Apparently so. The RBI actually received a Digital Transformation Award for PravaH and another internal workflow application called Sarthi. The report also emphasizes the RBI's prioritization of in-house IT development for core systems like eCouper 3.0, which is their central banking system.
Why is that focus on in-house development important? What's the rationale?
It's noted as a way to reduce vendor dependence. This aligns with the Atmanirbhar Bharat initiative promoting self-reliance, and it also likely provides greater control and security over these absolutely critical systems.
Makes sense. Moving to physical currency, banknotes, and coins, how is the RBI modernizing currency management? Still important even with digital growth.
Very much so. The report mentions Project Samudra. This is the initiative aimed at redesigning and modernizing the entire currency management architecture using technology and process reengineering.
Any key statistics on banknotes in circulation? How much cash is out there?
As of end March 2025, the value of banknotes in circulation increased by 6.0% year-on-year and the volume by 5.6%. So this shows cash is still very much in use as the economy grows.
And which notes are most common?
The 500 banknote continues its dominance. It accounts for about 40.9% of the total volume of notes and a whopping 86.0% of the total value. The share of the 2,000 notes, following their withdrawal from circulation, is now negligible, 0.02% of volume, 0.2% of value. Basically gone.
Right. And initiatives for coin circulation. Sometimes getting change is tricky.
Yes. The report notes efforts to improve coin circulation. Things like mobile coin vans, coin mellas or fairs, and packaging coins in small pouches to make them easier to handle. They're also working on standardizing the note sorting machines used by banks across the country by adopting a specific Bureau of Indian Standards, BIS, standard for them. That should help with efficiency and accuracy.
Okay, that's a comprehensive look at the systems that move money, both digital and physical. Finally, let's get a sense of the Reserve Bank's own inner workings, its strategy, communication, and its finances.
Right. The report covers the RBI's communication efforts, which are, increasingly important for a central bank in today's world. This includes public awareness campaigns under banners like RBI Kehta Hai or RBI Says. They focus on educating the public about RBI initiatives and warning about financial frauds.
I noticed the report mentions a shift in their campaign approach, moving away from celebrities.
Yes, exactly. It points to a shift away from using celebrity endorsements towards using mascots like Money Kumar and Miss Money, perhaps trying to be more relatable or cost-effective. They also significantly increased the number of campaigns conducted, 43 in 2024-25, up from 30 the previous year. So a greater push for public outreach.
And how is their communication policy adapting to the modern information landscape, social media, fake news?
Well, a revised communication policy, version 3.0, was issued in January 2025. This update specifically accounts for the evolving usage of social media, podcasts, and the importance of fact-checking. There's even a project being developed called RBI Suntahai, which aims to capture media cues. These could potentially serve as early warning signals or provide input for clarifications needed by the public, kind of listening to the buzz.
Interesting. Research and knowledge dissemination are obviously core functions for a central bank.
Absolutely. The report highlights events like the high-level conference Central Banking at Crossroads, held in October 2024 as part of the RBI at 90 celebrations, that brought together experts to discuss key issues facing central banks globally. They are also expanding the use of data science, AML for policy analysis, for instance, linking company borrowing and financial performance data for deeper insights into credit risk and economic trends.
Speaking of RBI at 90, what other activities were part of those 90th anniversary celebrations?
The report lists a whole variety of events reflecting broad engagement, things like debates, art competitions, sports tournaments, town halls to connect with staff across the country, and community activities like tree plantation drives and blood donation camps.
Okay. What's the strategic focus looking ahead for the RBI itself? Any planning cycles mentioned?
Yes. The agenda for 2025-26 includes reviewing the current midterm strategic plan, which is known as Utkarsh 2.0. And based on that review, they'll be formulating the next iteration, Utkarsh 3.0. This indicates the RBI is continuously evaluating its strategic priorities and planning for the future, maybe a 3 to 5 year horizon.
Finally, the report provides details on the RBI's own finances for 2024-25. What are the key takeaways there?
Key figures from the accounts include a provision of about 44,861 crore transferred to the Contingency Fund, or CF. The Contingency Fund is basically the RBI's buffer, maintained to cover unexpected risks or emergencies.
And the surplus transferred to the government?
The surplus transferable to the central government for the financial year 2024-25 was 10,000 crore.
How did their income perform compared to the previous year? Any major changes?
Net income from domestic sources actually decreased. This was mainly due to lower interest income from holding rupee securities. Also, the net interest income from LAF, MSF, and STF operations, these are key tools for managing liquidity in the banking system, was also more negative. That reflects the cost of absorbing or managing excess liquidity in the system during the year.
And how is the surplus decided?
The report notes that the application of the Reviewed Economic Capital Framework, the ECF, was used to determine how much risk provisioning was needed for the CF before the final surplus transfer amount to the government was decided.
Wow, okay. We have covered a tremendous amount of ground in this deep dive, going straight to the source with the RBI's own report.
We really have. We've looked at the overall health and prospects of India's economy, how the RBI is tackling inflation, the dynamics of financial markets and debt, the crucial work of regulating and supervising the system, the modernization of payments and currency management, and even, the Reserve Bank's own internal operations and finances.
It really gives you a sense of the sheer scope and complexity involved in steering a major economy's financial system. It's just this continuous process of assessment, careful regulation, innovation, and managing all sorts of diverse risks.
Indeed. The report makes it very clear that the central bank is constantly balancing multiple, sometimes competing priorities.
And as we've seen, especially in the areas of payments and regulation, the push for rapid digital financial innovations sits right alongside the crucial need for robust regulation and financial stability. Thinking about that constant balance, that tension almost between innovation and stability, what do you think is the biggest, most important question this ongoing dance raises for the future evolution of our financial lives?
That's a great question, and definitely something for you, the listener, to ponder as we wrap up this deep dive.
That's all for this episode of the FinGlimpse podcast. If you found our discussion insightful, please consider subscribing and leaving a review. We'd love to hear your thoughts and suggestions for future topics. Until next time, stay informed and make smart decisions. Goodbye.